Most investors chase growth, hype, or deep value, but there's a more disciplined, durable approach that has quietly produced some of the market's most consistent long-term winners: quality investing. It raises a simple but powerful question: why do a handful of companies keep compounding capital for decades while most can't even sustain high returns for a few years? In this video, we'll break down what makes a company truly high quality, why these firms often outperform the market over time, and how do they manage to fend off competition year after year. The answer lies in durable business models, efficient capital allocation, and something called an economic moat. Quality companies tend to deliver stronger returns on capital, generate more consistent cash flows, and often hold up better during downturns. This video will explore what the research says about moats, return persistence, and long-term value creation, and show you a framework for spotting the real thing. Let's dive in. Investing for the long term means seeking companies that can create value year after year, and sustainable value creation requires a lasting competitive edge. In finance terms, a company creates value by earning returns on invested capital above its cost of capital over time. A strategy at its core explains how a company achieves that sustainable value creation. The presence of an economic moat often distinguishes those rare companies that generate economic profit for decades from the rest that merely earn their keep. Moats and Callahan's paper Measuring the Moat from 2013 put it plainly: sustainable value creation is rare, and sustainable competitive advantage is even rarer. Most businesses eventually see their profits competed away, but a select few, the quality companies, manage to buck this trend by virtue of strong moats. Why do moats matter so much? Because competition is relentless in a free market. Any company making fat profits attracts attackers. As Greenwald and Kahn explain, if a firm has no defenses, other companies will notice the opportunity and flood in. High profits that attracted the new entrants will disappear. Conversely, a company with a deep and wide moat can fend off these rivals and continue earning outsized returns. In quality investing, Cunningham reinforces this, observing that while almost all high-performing businesses face reversion to the mean, the regular exceptions, the outliers that sustain superior returns over the long term, are those with durable competitive advantages. In simple terms, only businesses able to defend their economic castle with patent walls, brand loyalty, cost leadership, network effects, etc., can keep compounding value for decades. Investors who allocate capital for the long run should therefore insist on evidence of a moat before trusting that a company's high performance will persist. It is important to recognize how rare sustained high returns really are in the corporate world. Competitive forces and innovation exert a powerful gravity, pulling extraordinary profits down to earth. Empirical research shows that when companies achieve high return on invested capital and invest heavily in growth, their success often sows the seeds of competition. High returns plus big growth runway act like a magnet for rivals. New entrants pile in, pricing gets aggressive, and best practices diffuse across firms, eroding the leader's edge. The result? High returns attract competition, generally causing economic returns to move toward the cost of capital. In other words, today's exceptional profitability usually fades toward average over time. One study cited in Measuring the Moat found that the period during which companies can sustain value-creating returns has been shrinking over the decades as the pace of innovation increases. For example, consider how quickly dominant companies can falter when a new competitor with a better model emerges. Think of Blockbuster versus Netflix, or Nokia versus iPhone. Once formidable castles laid low by lack of an unbreachable moat. Buffett has noted that moats are almost always widening or narrowing. They never stand still. Without constant reinforcement, even a once wide moat can be crossed. That's why he looks for CEOs who prioritize widening the moat over delivering short-term results. It underscores that high returns alone don't guarantee a safe long-term bet. It is the competitive durability of those returns that counts. Importantly, some companies do manage to sustain exceptional return on invested capital for very long periods. And those are the ones with true economic moats. Quality investing notes that although abnormal returns tend to fade over time, there are notable exceptions. Businesses able to buck the statistical trend of mean reversion and sustain superior returns over the long term. These are often elite firms within their industries, protected by multiple reinforcing competitive advantages. Take Coca-Cola and PepsiCo. Both have operated for over a century and consistently generated high returns, yet they have done so through distinct moat structures. Coca-Cola has built one of the most powerful global brands in beverages, with unmatched distribution and pricing power in soda. PepsiCo, on the other hand, has evolved into a diversified consumer staples giant, with its Frito-Lay snack division, including brands like Lay's, Doritos, and Cheetos, contributing a large and growing share of profits. While both companies share a category and legacy, PepsiCo's enduring performance owes more to its dominance in salty snacks and to carbonated drinks. Despite competing in the same broad industry, each firm carved out its own defensible position and built a resilient moat, proving that long-term outperformance is possible when structural advantages shield profits from competitive erosion. If moats are so critical, one might wonder, isn't being in a good industry enough for a company to win long-term? Industry dynamics do matter, but firm-specific advantage often matters more. Average profitability varies across industry. Some sectors like software tend to earn excess returns, while others like airlines or steel often struggle to earn their cost of capital. However, even in great industries, not every firm has a moat, and even in tough industries, a smart player can carve one out. As Moat's research highlights, even the best industries include companies that destroy value, and the worst industries have companies that create value. Industry is not destiny. In this chart of measuring the moat, the author showed that within a single industry, the spread of returns can be huge. Some firms wildly outperform while others lag far behind. This suggests that what a particular company does, its strategy, execution, and moat, can override the broader industry economics. Greenwald and 𝐾𝐿 make a similar point. Beyond general 5 forces industry analysis, the crux of strategy is identifying which specific advantages a company has and can sustain. In Competition Demystified, they simplify competitive advantages into a few categories: cost advantages, customer captivity, and economies of scale primarily, and note that these advantages often handle a local or niche element. For instance, a regional player might dominate its local market behind a moat of customer loyalty or scale, even if its broader industry is brutally competitive. Conversely, a weak player in a lucrative industry, say a minor software firm in a high-margin tech sector, won't magically prosper without its own edge. In practice, many enduring moat companies manage to thrive in spite of industry headwinds. Take Southwest Airlines as an example. Airlines as a whole historically barely broke even, but Southwest carved out a cost advantage moat, point-to-point routes, quick turnarounds, a single aircraft model that let it earn profits when most rivals couldn't. Conversely, consider the tech hardware industry. It is fast changing, a graveyard for those who can't keep up. Yet Apple built a formidable ecosystem moat, with iOS, App Store, and brand prestige, enabling it to earn margins few hardware makers ever see. The lesson is that the competitive advantages are idiosyncratic. They stem from unique choices and capabilities of the firm. Industry growth or macro trends alone don't guarantee long-term success. It is the company's moat that does. As one study summarized, companies that consistently outperform buck the economics of their industry, often by being different in strategy. They either do something fundamentally better than the competitors or operate under protective conditions competitors cannot easily replicate. How can investors apply these insights? It boils down to analyzing both the company's qualitative advantages and its financial performance for signs of a moat, then continually monitoring for moat erosion. Here's a practical framework from the books and papers discussed. First, understand the source of the moat. Pinpoint why the company might have a competitive edge. Is it a cost leader, allowing it to price lower than rivals? Does it enjoy strong customer loyalty or switching costs that lock in repeat business? Does it benefit from network effects? The product becomes more valuable as more people use it, or proprietary technology or intellectual property. Morningstar's equity research, for example, classifies moats into 5 categories: network effects, intangible assets, cost advantage, switching cost, and efficient scale. If a company clearly possesses one or more of these, it likely has a real moat. For instance, a firm like Microsoft in the late 1990s had a dominant platform, Windows plus Office, a mix of network effects and switching cost moats, which competitors found nearly impossible to dislodge. As an investor, write down the specific sources of a company's moat and check that they are truly unique and defensible in its competitive landscape. Second, examine the financials for moat metrics. A qualitative story is not enough. The moat should show up in the numbers: high return on invested capital, well above the cost of capital, are the telltale signs of value creation. Look for consistently superior profit margins or asset turns that competitors can't match. For example, quality investing advises zeroing in on gross profit margins, because gross margins largely reflect the value customers see minus direct costs. Sustained high gross profit margins relative to industry peers tend to indicate durable competitive advantages. A company with a 60% gross margin in an industry where everyone else is at 40% likely has brand power or a unique product, rather than just better cost control. On the other hand, net margins can be boosted temporarily by aggressive cost cutting, so they are less reliable for moat detection. Additionally, check return on invested capital stability. Are returns holding up for many years? A gradual decline in return on invested capital or margin could signal that competitors are eating away the business. Next, assess the competitive life cycle. Mabussin's framework suggests asking what stage is the company in. Early stage innovators might earn high growth and high returns for a while, but inevitably face fading returns as competitors enter. A mature moat company, by contrast, may show slower growth but remarkably steady returns, indicating a well-fortified position. What stage of the competitive life cycle is the company in? Is the company currently earning a return above its cost of capital? Are returns increasing, decreasing, or stable, and why? What is the trend in the company's investment spending? These questions help distinguish a temporary winner from one with enduring advantages. If a firm's returns are both high and remarkably steady, or even rising over say 5 to 10 years, and it is still investing in its business, that's a strong positive moat signal. In contrast, if returns are slipping or the company most drastically boosts spending just to defend its turf, the moat might be narrowing. Finally, monitor moat trajectory. A moat is not a static feature. As Buffett noted, all economic moats are either widening or narrowing at any given time. Once you've invested in a company for its moat, keep an eye on competitive developments. Is a formidable new entrant emerging? Is technology changing the basis of competition? A shift to streaming undermined cable's TV moat. New drug innovation can erode a pharmaceutical company patent moat. Pay attention to management's actions. Are they reinvesting in the moat, research and development, brand building, widening their network, or just milking the cash cow? Buffett's criterion is to favor managers who focus on widening the moat, even at the expense of short-term earnings. If you start seeing signs like price wars, eroding margins, key customers leaving, or leapfrog innovation by a rival, it may mean that the moat is deteriorating. Investors should be ready to revisit their thesis. If the moat is narrowing and looks likely to disappear, long-term capital may be better deployed elsewhere. In summary, investing for the long haul means stacking the odds in your favor by owning businesses with proven defendable moats. All the evidence, from Buffett's decades of experience to detailed studies like measuring the moats to the patterns observed by quality investors, point to the same conclusions. Companies that can sustain high returns and keep competitors at bay are exceedingly rare. But those are exactly the compounding machines that deliver outsized investor returns over time. As investors, we should demand nothing less for our long-term capital. Identifying a true economic moat requires deep analysis and ongoing vigilance. But the reward is a portfolio of businesses that not only prosper today, but continue to thrive for years and decades to come. The only businesses truly worthy of indefinite investment.